Interest rates are high. In fact, the highest they've been in a generation. And if your fixed-term mortgage is up anytime soon, that's not great news. Now, you won't find many two-year fixes currently under 6%. But if you're keeping an eye on your savings account, well, the rates don't match up. Some instant access accounts are still below 1%. Just looking at a comparison site and what some of the big banks are currently offering, TSB is offering 2.5%, the Co-op 2.25%, and HSBC is even lower. In fact, it's 1.75% for your savings. And understandably, people are just not happy about it. In fact, many campaigning for consumers say it's unjustifiable. Banks say they've got to balance the needs of savers and lenders, and there are good deals out there, but they're under pressure to make changes. I'm Sally Lockwood, and on this Sky News Daily, is anything going to change to close the gap between mortgage and savings rates? And what could that change be? Well, to explain all this, I'm joined by our business correspondent, Paul Kelso. Hi,
Hello.
Paul. And by Danni Hewson, who is Head of Financial Analysis at the investor platform AJ Bell. Hi, Danni.
Hi.
Thanks so much for joining us. There's a lot to walk through here. Paul, let's kick off with you. And we'll start with the basics. Interest rates at the moment, they've recently reached a 15-year high.
Yeah, that's right. Interest rates currently 5%. That's after 13 successive rate rises going back to 2021 from the Bank of England. So it's a really rapid and enormous change in the cost of borrowing money that hasn't just caught out consumers and households. You shouldn't feel bad about it. Huge organisations, governments, regulators, utilities, pretty much everyone is adjusting to this massive shock and change in the interest rate environment.
And the most recent inflation figures didn't just show that inflation in the UK is sticky, it's stuck. And now they're, of course, predicting that the base rate of inflation is going to get even higher before Christmas.
Yes, there was this hope and expectation, in fact, that interest rates would come down and come down pretty rapidly. Economic gravity would take over. It hasn't proved to be the case. Inflation's stuck, and that's a big problem. It's a problem politically, we know, for the Prime Minister, but it's a practical problem day to day for households, businesses and government.
What does this all mean for mortgage rates, Paul?
It means mortgage rates have gone up. We're talking at the end of the first week in July, we're talking about rates for a 2-year fix at just above 6.5%. And that is a pretty steep climb. We had the last really steep climb was after the Liz Truss Kwasi Kwarteng mini budget. Well, those 2-year fixes are now costing even more than then. A 5-year fix is going to be above 6%.
And before we bring in Danni, one of the main themes that we're going to be talking about today is the fact that savings rates, which in theory should also be increasing as interest rates increase, are not giving the same returns.
No, they are going up. Savings rates have increased. Again, end of the first week in July, above 2.4%, 2.5%. Remember that mortgage figure, 6.5%. That's a 4% margin. That is very healthy. You go back to just before the interest rate hiking began at the bank, when savings rates were bumping along just above zero, the margin was 2%. So the margin has doubled, and that is what consumers have definitely noticed, a lot of media have noticed, and the government has noticed, and that's why the banks essentially are on notice to provide better deals.
OK, good time to bring in Danni. You know, Danni, if you're a consumer right now and you're feeling squeezed at every angle, you're paying a lot more for your mortgage, you're worrying about making ends meet, and then you're seeing that you're not actually even benefiting from having savings in the way that you might expect, you'd be, within your rights to think, what the heck is going on here?
And I think a lot of consumers are thinking exactly that. There is an awful lot of anger that they seem to be squeezed on every side, particularly because, as you say, it's incredibly quick for those mortgage rates to go up seemingly almost on a daily basis. But of course, then we get the savings rates not responding in the same way, particularly if you stick with your sort of traditional accounts, those easy access accounts. That said, I think the consumer has to bear some responsibility here, because there are much better rates out there if you are prepared to look for them, particularly if you're prepared to hunt for them online, and particularly if you're prepared to lock your money up for a year, 2 years or so. Then you can get a pretty chunky deal. In fact, the best one-year bond is paying 6.1% now. So there are deals to be had. And I think, we've got used to not chasing those deals because we've had over 10 years where interest rates have been so low, and because inflation has been so low, that those savings accounts with decent chunky returns just haven't been out there. So people have looked elsewhere. They've looked at equities, those kind of investments, but they haven't got used to looking for better savings rates. And I think that's definitely what they need to do.
Yeah, that's an interesting point, isn't it? People have been so used to these interest rates that have been so low for so long that it may not have been on their radar. But now, of course, you can make some money on your savings. What would you advise people who do have some savings at the moment, but certainly aren't getting the rates that they might deserve in their instant access savings accounts?
I think they need to look at other instant access savings accounts. So according to Moneyfacts, the best one at the moment is paying 4.35%. So that's not a bad rate. If you are prepared to lock your money up for a year, 2 years, you can certainly get a better return. Though, of course, with the cost of living crisis the way it is still, people do need to make sure that they still have enough cash in an easy access account to cover at least 3 months, preferably 6 months of bill in the worst case scenario. But, I think another thing that people really do need to think about is there was an awful lot of savings amassed during the pandemic because people weren't going out, and those lucky enough to still have a job, to not be furloughed, they managed to put aside quite a bit of cash. And as interest rates have started to creep up, and as wages have started to creep up as well, those accounts have grown. And now some people are finding for the very first time that they're having to pay interest on their savings. So there is something called the personal savings allowance, which allows a basic rate taxpayer to earn £1,000 in saving interest every year, and a higher rate taxpayer £500. So there are a number of people now bumping up against that limit, bumping up to a point where suddenly they're finding that they're having to pay tax on their savings interest. So if you do find yourself in that situation, you might want to consider looking into a cash ISA.
Looks like you want to jump in there.
Danni mentions the savings pile that, contrary to how things might feel for a lot of people, has grown. There's a couple of practical consequences, one of which Danni touched on, but there's an economic consequence as well. Right now, around 60% of people, is a rough rule of thumb, have some kind of savings. Now, a lot of people will have none, and I'm very conscious of that. But that increase in rates, that's instant. That's instant earning. That build-up of savings during the pandemic, that's now earning more money for people. And the economic consequence of that, well, a lot of people are sitting on quite a lot of savings, and that money is still being spent. That's why the economy, actually, you hear the word resilience. The Bank of England could do with the economy being a bit less resilient. People actually say, you know what, I'm going to stop spending. But those savings, which are earning more money, are actually giving people the ammunition to keep living, some of them, in the way they did. About £25 billion extra has been earned by UK households as a whole from savings. That compares to £12 billion more we're spending on our mortgages. So actually, net, we're in profit from these rates. It doesn't feel like it.
No.
For
a lot of people,
a lot of people, it doesn't. That's partly a consequence of fixed rate mortgages. For a lot of people, this is still theoretical. But boy, when it becomes practical reality of coming off your rate, you will notice it.
But yeah, let's talk mortgages. Hundreds of thousands of people are set to come off those fixed term deals, and they're going to be shopping around for a new mortgage product. At the moment, how do things stand in terms of what they should be looking out for? Danni, to you first.
They're not going to look great if you are going from a sort of around 2% rate to 6.5%, which is for your average 2-year fixed. It's not going to look great at all. I mean, you're talking about having to find hundreds of pounds extra for your mortgage. And this is something that I get more social media correspondence about than anything else. What should I do if my mortgage is coming up for renewal? And I think the best thing to say is do talk to a broker. If you are 6 months out, you can set your rate right now. You don't need to go with that. If interest rates fall, and unfortunately it's not looking likely, but if they do, then you can go with the lower rate. But it does mean that you can lock in that rate now. For some people, if your mortgages are still incredibly low, and you can put money into a savings account and make more, then actually you might be better amassing those savings, growing that savings pot, and then paying off on your mortgage. So it really is worth crunching the numbers. There are options out there, but for a lot of people, this is going to be painful.
For people who are extremely concerned about renewing their mortgage deal and who are concerned they won't be able to make ends meet, what are their options? Can they move on to an interest-only deal, for instance?
Yeah, I mean, we did have an agreement from a number of banks after having a conversation with the government and regulators that they would create limited time measures. So 6 months of time where you can drop onto an interest only deal or extend the term of your mortgage without any kind of penalty in terms of impact on your credit score. You will obviously end up having to pay for a longer period of time to make up the money that you're not paying in order to achieve that bit of breathing space. And also something that a lot of people haven't really considered, if you're going to extend the term, so you're going from the sort of traditional 25-year term to pay off your mortgage, if you then go to 30, 35 years, maybe even 40 years, are you nudging into retirement then? Have you factored that in when you thought about your pension and how much you're going to be able to live on? Because most people, when they start thinking about pensions, are thinking that they won't have any housing costs if they are a home owner. So there are options. It is definitely worth talking to your lender. If you are worried, if you are concerned that you're not going to be able to meet your payments, that you are, heading towards arrears, have that conversation first. Your lender has a duty to help you. And what is clearly not in the interests of the country, of the government, of the Bank of England, is to have people in a situation where they are losing their homes. This is designed to hurt, but what they don't want it to do is cripple.
Now, Paul, just back on this anomaly between what people are paying in their mortgage rates and what they're earning in their savings. A lot of people are feeling really under pressure financially, and there is pressure for this to change, including from the Chancellor. He has had a meeting with the Financial Conduct Authority, the body that regulates banks. What do we know about what happened in that meeting?
Yeah, the FCA, Financial Conduct Authority, has been looking at this issue for a year. It has been looking at the deals banks offer its customers, whether banks treat consumers fairly and what can be done about it. Great deal of political pressure around the cost of living. The Chancellor's worried on our behalf. You'd expect him to be. He had a meeting with regulators across the big industries, the regulated utilities and the banking sector. One of the things he asked the FCA to do was to look at the deals being offered to customers, something they were doing anyway. That resulted in a meeting in the first week of July, and I was at the meeting. I was outside the meeting, which I'd been inside it, but I was outside it, struck by how many chief executives were there. They were all there, and it was to discuss specifically this issue of savings rates. What is going to change at the end of July, banks will be under a new obligation to their customers, and I'm going to give you the FCA jargon. It is a new consumer duty to protect customers' interests. One of the things it will require banks to do is make sure products and services meet customers' needs and offer fair value. So that was the context for the meeting. Essentially, they were publicly showing what they were already doing. Now, practically, is that going to result in higher rates for savers? Well, a couple of the banks On the way into that meeting, by the time the bosses got there, they'd already offered slightly improved rates. There's no question a bit of sunlight from the media, a bit of consumer pressure does pay dividends, almost literally. Are they going to really steeply increase? I'm not convinced they are. This is a bank's prerogative, right? It's offering a service. It is a pretty competitive market, but there will be, for the first time, this duty to offer fair deals. Now, define fair deals and define it in an argument with a bank that's offering a whole range of products. They don't just lend for mortgages and saving. It's a huge, complex system that we want. Remember, we're still in the post-financial crash world where we were appalled at the actions of the banks and we want them to be more responsible and more risk-averse. Now, more risk-averse means thinking twice before you lend. This is one end of that spectrum. It's not great for consumers. It's not a great environment for savers, but it's a consequence of all that's come before. But things should change.
It's all quite overwhelming for consumers, isn't it? Danni, what would you advise people right now? You know, if they've got savings sitting in a bank account, the bank's certainly not going to come knocking saying, oh, hey, we can give you better.
You are going to have to go looking for it. And I think a lot of people are incredibly tech savvy. You know, they've got used to shopping around for the best value for their groceries. When they could, they'd got used to shopping around for the best value for their energy. This is absolutely no different. I think consumer duty, though, is really important. And of course, there are a vast number of people who are not quite as tech savvy. I'm thinking about people of an older generation who maybe like to go into a branch, talk to people on the phone. They're the ones that are unlikely to be able to shop around quite so much. And I think the fact that they're sort of being penalised for their loyalty isn't great. So I think the high street banks really do need to pull their fingers out because they have been increasing their net interest margins. You know, we saw first quarter results with profits up substantially for these banks. And they do face potentially becoming as big an enemy to the consumer as those big oil companies were when we were all talking about windfall taxes. And this is pretty tricky because, we did bail out the banks.
One of the things the FCA really does want is precisely that point you're making. The big banks to act like the smaller banks and be much more proactive in encouraging people to save, seeking out savers among their existing customers, offering perhaps sweetening rates to draw people in, offering deals in which you might be linking saving to some of your borrowing. And one of the reasons they want to do that is pretty grim. Because this is a luxurious argument to have, isn't it, about whether savers are getting a decent deal. As these fixed rate mortgages, which are slowly going to work through the mortgage market, 90% of people are on a fixed rate. That's a massive change in the mortgage market. In 7 years ago, it's 50% of us were floating. We've all tied up on this. As they come back and people start to face these massive new rates we talked about, there is serious hardship coming. And the question to the banks won't be, why can't you give me a little bit more for my savings? It's going to be, how are you looking after and acting fairly with hundreds of thousands, maybe millions of customers who can't pay their mortgage? And if they're saving, that cushion could be crucial.
It's quite a sobering thought, isn't it? And actually, it brings me neatly on to another issue that I'd like to talk to you both about, which is the fact that we're expecting the latest data on the labour market. And there are fears that high inflation could lead to the labour market cooling off. Paul, what could we potentially see when those figures drop?
It would be absolute music to the Bank of England's ears. They've got more than one ear. If the labour market is cooling off, because for my money, and on the basis of covering this story over the last 18 months, the labour market, pretty much the number one issue in the inflation picture. We have a shortage of workers in the UK. We still have nudging 1 million vacancies. That's jobs not filled, and that's almost as many people fall under the definition of unemployed. So we have almost 1 for 1 empty jobs and people who need a job. The economy is struggling to meet demand because it hasn't got enough workers. And until that changes, you can't uncork the pressure on inflation. So really big day when these labour figures come, because they will inform all the thinking in the markets about what's coming in the next interest rate decision, which is at the beginning of August, that will inform what happens next and ultimately land on every household's decisions and the bills they're going to have to pay.
On the whole, things are pretty bleak for a lot of people, Paul. For any listeners who are thinking, God, I'm worried about making ends meet, I'm worried about paying the bills, worried about my mortgage, is there anything positive we can give people to end on today? Oh, now you're looking up at the ceiling, thinking, that worries me.
I really struggle. I think the fundamentals of the economic bind we are in at the moment need to change. Why are interest rates rising? It's because inflation is high. When are interest rates going to fall again? Well, when inflation's not just 2%, but in danger of falling below. That's the target. So that looks like we're a long way off. We may well all be through our fixed rates by the time interest rates have fallen, and until there's a fundamental change in the labour market conditions, which might only come with a recession. So the good news is really bad news. So there are people better qualified than me to opine about what the economy looks like for next year, but I don't expect to be breaking out the bunting.
People probably better at PR than you as well. I mean, that was very much a journalist's answer, wasn't it? We didn't really get a warm, fuzzy answer there. Danni, we may be lacking in positivity in this podcast. Is there anything practical you can offer people to end on?
I think the most practical solution to everything is to be forearmed. So if you have a mortgage which is up for renewal in the next 12, 24 months, figure out exactly how much your term is, what your interest rate was. Start thinking about how much you can potentially afford to pay. And if you can start to amass savings, then do so in order to sort of cushion you when you reach that point. I think the other thing is that we have become very good at shopping around in order to get value. I think we need to do that in every part of our lives. If you are prepared to do that, although, of course, it does take time and a lot of us are time poor, but you can really make some serious savings. One tiny, tiny silver lining is that food inflation does seem to be coming down. And because the supermarkets are desperate to keep hold of their customers, to stop them, following the march of the discounters, then we are seeing an awful lot of price cuts and price wars. And all of that does help our pockets.
Danni, Paul, thank you so much.
Pleasure.
This episode was produced by Rosie Gillett and Alex Eden. The editor is Paul Stanworth. See you next time.